welcome to VW Exchange, episode 23. Very excited to bring you this episode with a special guest. I'm joined, as usual, by my co-host James, but today I'm joined by Marco Mandelli-Valla. Welcome to the show.
Thanks for having me, guys. Appreciate it.
So we have a good slate of stories, and I guess we're just going to start it off with, I think we'll just go in order. We'll start with one of mine.
Yeah.
So I thought this story was interesting. This is on continuation funds, and it's looking at a fund by these guys called Platinum Equity. And just to give the timeline, in 2021 is when this continuation fund manifests itself. So they had, I'm forgetting the dollar valuations. I think it was $1.4 billion were in the original. And then they sold it into the new fund. So this was a deal between funds for $4 billion. And a year ago, there was an out-of-court restructuring. So I think things weren't going so good in this business. And just to give a little bit about the business, this is a porta potty business. So not the sexiest by any means, but and it was supposed to be a stable, durable business. But one that is partially impacted by COVID, with people maybe going to less shows. You need less porta potties, less outdoor events, etc. But so they obviously, this was a debt-ridden company, as firms that are owned by private equity sponsors typically are. And then in October 25th, they went into forbearance of some of their covenants. But all that aside, the main point is that now they're staring down a loss, and it's bringing into the question, okay, with continuation funds, is there a conflict of interest here that the person who is selling the asset, the fiduciaries of this old fund, who are selling it to the new fund, and so what are the fiduciaries on the new fund trying to do? They're trying to get the cheapest price possible for their investors. People in the old fund are trying to get the biggest price possible for their investors to deliver that capital to them. Oh, by the way, it's the same person in these instances, so maybe there's a problem there. But I just want to flip it to you on your thoughts, because obviously these things have pros and cons, and none of these new financial techniques come in a vacuum. So whatever thoughts.
Yeah, I mean, I guess what I would say is I think what's interesting with this whole continuation fund dynamic is you kind of hinted at it a little bit, who's involved with kind of taking over these companies and then continuing to run them, or taking over an asset and continuing to run it. To me, what really matters is who are the LPs involved, because if the GP is going to be the same, I think if the LPs have some continuity as well, then there's not as much of a concern, because these guys are going to have a little bit more of an understanding of, hey, let's just hold on to this asset a little bit longer. The unfortunate reality is a lot of LPs are just going to want to monetize and get out. And so in order to hit a certain IRR, they're going to need to get out at a high price, like you were saying. And so I think continuation funds in general are just, it's going to be very, very difficult to kind of make both sets of LPs, given that they're different, make them both satisfied to some degree.
Right.
Yeah. Love it, Marco. Love it. But yeah, fund to fund is definitely an issue. And just looking into this specific case, we kind of thought porta potties are going to make a big comeback. They had the big valuation spike during COVID, kind of hoping, after shows, events were going to open back up. But never really got to the place they needed to go. And, you can kind of look at it as a one-off sort of thing, but it kind of seems like this fund-to-fund issue is becoming more persistent and, as you said, kind of conflict of interest here.
And I think that, just to underscore, I think that I would imagine most private equity firms would say that their ideal buyer is some sort of strategic that is going to be able to pay a higher price, because you can integrate all these synergies. Yeah. And we're going to talk about Paramount later, and I'm sure that they're trying to spread out those costs, etc., and they're trying to realize some synergies. But if you're just selling to another private equity firm who's going to continue to try and strip it down and squeeze it for every dollar that you can make, then it makes it even harder. So I guess that's all I have to say there, unless anybody else has anything.
I mean, the only thing I would say is I think to me the main pitch would be that you switch private equity firms on a routine basis. There have been many cases, especially if you look at the industrial sector or things like that, where it's not necessarily tearing something down to the bones, but you have a solid company that's generating consistent enough cash flows where you can hit a certain IRR without any trouble. And those companies have been passed along by 4 or 5 private equity firms over the past 20 years, and there really hasn't been much of an issue. So I do think it just depends on the type of company that you're working with to some degree.
Got it.
Yeah, I'll echo that. And last thing, this kind of can be rooted to the lack of market activity recently, kind of having a tough time either going public, which is sort of a typical exit route, or just finding another complete seller to go to. So that's kind of where it stems from, but as you guys said, good points.
Yeah.
And then we have this Bitcoin story is the other thing I wanted to talk about. We just had a unit on this in class, so we've been primed somewhat, but good to have a new voice in here because this is something that we haven't actually got around to discussing at all. And so this was from Apollo's research of just a news headline that it looks like that Bitcoin is slightly showing that it has some ability to be uncorrelated with the stock market. It's notable that this is in a downturn, that Bitcoin is going more down than everything else. But I thought that it was notable because I think that is something that's important for Bitcoin as to legitimize itself as an alternative asset and an inflation hedge is to be able to become uncorrelated to some degree. But I don't have too many thoughts beyond that, so I'll flip it to you guys because I know that you said that you have some points.
I mean, look, so the thing with me is I've generally been kind of in the camp of not being on board with Bitcoin for a long period of time, but I've read a lot recently, and I'm speaking from a place of complete ignorance. This is just what I've kind of picked up here and there. My understanding is that Bitcoin and crypto in general are going to be relatively easy to integrate with AI systems and things of that nature. And so I think that on that basis alone, they have some merit. I also think in terms of the fact that a lot of currencies become unstable recently, you look at things that people are looking to as havens beyond currency, whether that's gold, and now you have crypto emerging as an option as well. I don't see any reason why, if you're looking to diversify your portfolio, you don't look at least at a little bit of crypto. So I think it's going to have some longevity just because there are enough pockets of investors in our society that are willing to invest in something like Bitcoin. There are some people that think we'll have $1 million Bitcoin in the next 5 years or something like that, which that's probably way more bullish than I would say I am. But I think that if you just look at kind of the exponential growth, there's clearly something there.
Yeah, I mean, I honestly don't know too much about crypto, but can't say it looks great when you talk about, okay, maybe it's not correlated with the market, but if the market goes down 1%, it goes down 2%. Is that really an asset you want to have? But we also seen its steep climb over the years. It's sitting around 90 grand now. It peaked at around 130, 140. Yeah. So I'm sure there's value there, and as you said, I think it's definitely worth diversifying your portfolio with at least a little bit of crypto with the amount of people who are in on it. But is that a valid investing point? I don't know about that.
It's just tough. I think if you look at some of these assets, there's a very, very clear way that they react relative to the overall market. And crypto just does not have a pattern that you can as clearly identify as some of these assets. You look at infrastructure, it's constantly generating 10% return regardless of market conditions effectively. You look at gold, it's kind of moving. Gold moves in a very different way from the market, but it is more predictable. Crypto is just in a league of its own in terms of the volatility.
Do you think that, because my theory is that as Bitcoin settles out and sort of this volatility that comes with it being a new asset, and that people, the institutions and sovereign wealth funds maybe aren't as bought in as maybe they will be in 10 years, et cetera, that puts a floor on Bitcoin. And so maybe when that happens, you start to see it behave more like gold and more like an inflation hedge, because I think the underlying structure that makes someone want to buy a gold or want to buy a Bitcoin is that, and this is something that we do talk about a lot, is that we have these monetary and fiscal policy regimes where we run big deficits and then we do QE when things are bad, and as we talked about last week, that we don't tighten it away and that we still sit with $9 trillion or whatever dollars more in circulation. And I think that is a structural phenomenon, a political phenomenon, really, that we have just an expansionary bias and we have a political bias towards spending now and saving for later, and that if you're an investor and you want to hold, fixed income or whatever that's seen to be safe, that if you have Bitcoin where you know the purchasing power is going to hang around because there are only 21 million coins, maybe that, I don't know. Maybe that's the case for Bitcoin in my mind, because it has some advantages against gold. Like, you have to ship gold overseas. I have a big block of gold that I have to like move around.
Correct.
And Bitcoin is just like some digital, some nothing. But I
Whatever
guess that's a feature maybe.
Yeah.
Maybe it's a feature, maybe it's not. I don't know. But in a digitized world, it's hard to think that it won't have some sort of prevalence.
Correct.
So
I think the question becomes how broadly accepted it becomes by these institutions, and that is going to shape its value and its floor. Yeah. So pretty much what you were saying. Yeah.
But like, it's interesting in its own way that like the whole value is just based on like other people say it's value, so you say it's value.
Yeah.
Like,
I mean, I think currency as a whole is generally rooted in that, right? I mean,
exactly.
I don't want to get it like too philosophical or existential or anything like that, but we're just saying paper has monetary value. So,
Gold, similar thing.
a lot of these things are completely arbitrary, right? So if society as a whole, or at least a large majority, is willing to state that Bitcoin has some inherent intrinsic value, then for all intents and purposes, it does. And so that's really going to be the question, in my opinion.
love it.
Well,
Thanks
you
for
guys, smart guest on the show.
Thanks for shining light into the Bitcoin world. This is something we usually steer away from, but
I still don't know if I'm letting my grandma give her a new tip, like put 1% of your.
Steer clear.
it's not financial advice.
Yes, indeed.
You don't want to take financial advice from us, yeah.
So and I hate that all my stories seem to be like somewhat dense. But I thought that this story was interesting, and one that we talked about a little bit ago, but I thought that this was just a great piece of journalism that I wanted to give some love to. But this was a story around Meta had a new data center deal that they went out to the capital markets for, specifically in private credit for, via PIMCO, and I think maybe Blue Owl was part of this too. But it was interesting that they thought that there was some sort of aggressive accounting going on here. Between whatever this JV was between PIMCO and Meta, and whether Meta should be putting this on their balance sheet and consolidating those assets and those liabilities from this project. And the real trick here is happening with these operating leases versus capital leases. And I remember this from like the dark days of the advanced section of the 400 questions and stuff, was that with some of these operating leases, this is an operating lease by the rule of the book, that because it's a 4-year lease, it's not long enough, and Meta has options to renew. But what these journalists are saying is that Meta has to not be a primary beneficiary of this deal, so it can't have control over economic performance, and it can't have skin in the game, essentially, about having its performance tied to this deal. I didn't quite understand that one as well. But what was also notable is that there's a residual value guarantee. And so, reading off of what the journal said, this means that Meta pledges to cover bondholders for the full amount owed if Meta doesn't renew its lease or terminates early. So the real contradiction here is that if Meta doesn't renew its lease, it's willing to pay for those liabilities, but at the same time, them saying that, we have 4-year options, like we don't have to renew, is what's making this an operating lease and not a capital lease, and not having to go on their balance sheet. And so, I mean, all this is like not super important to get into the details, but what's more important is just the trend of off-balance sheet financing, because we saw this with First Brands, which we talked about not that long ago, about how all these creditors looking at the company and like, okay, all these debt ratios look fine, like these bonds are going to trade at 100 cents on the dollar, and then all of a sudden it crashes when you see, they have all these asset-backed liabilities or all these sidecar vehicles. And I think that's something that's going to make it increasingly tricky for these AI companies that want to maintain the pristine credit rating, but yet, Meta's not a good example of this, but something like OpenAI is burning cash and are going to need to finance somehow. So that's just something I wanted to bring up, and maybe if there's anything that you've seen or anything that you find problematic or not with this story or others.
Yeah, I mean, I think what I would say is, to me, what I see over here is the overarching trend of this kind of insatiable demand for data centers and things like that. And people are willing to finance it by whatever means necessary. And if that involves shenanigans like this, I think a company like Meta is. You'd like to think a company like Meta probably won't end up in a scandalous situation like a First Brands, because they have enough revenue streams to probably cover whatever comes up, even if this does become problematic in some sort of way and the data center bet doesn't pay off. But I do think, frankly, I am a little bit concerned by a lot of companies seeking financing beyond their balance sheet, just because if you're starting to resort to these different methods to kind of conceal the way that your company is funding its operations, it's just not a good sign of health, and it does show that maybe you yourself actually have some doubts about the bets that you're making.
Yeah, no, I echo that. And I think that even when you're looking at some of these credit ratings that a lot of these companies have, maybe that doesn't tell the full picture as we've been seeing so far. And maybe when you see, Meta has whatever, AA credit rating, maybe you don't really think of that as highly anymore. Maybe whenever you're seeing these credit ratings, you just assume that it's actually one lower. So that's kind of what I think. And, I'm not sure how you would go around this issue at the moment. It seems to be kind of deeply rooted in gap and kind of the things that are going on here. But I don't know. It's a little bit fictitious, and I don't know. We'll see.
I like the one thing that I kind of thought about when we first read this story is I was like, this doesn't seem like a good deal for these lenders who are in for X amount of $1 billion in an off-balance sheet vehicle that doesn't have the same sort of corporate guarantee. But by having this residual value guarantee, like this is effectively a corporate guarantee on Meta's credit rating. So, and to me, it seems like the real shenanigans are happening more on Meta's side than the lender's side. So I thought that was worth noting too. But that's all I have on this, unless we want to move to our other data center story.
Yeah, I mean, my story, I think, if you're all good on this one, my story kind of also touches on data centers a little bit. It's more on the dynamic of the fact, to me, it's talking about how data centers are creating this opportunity for construction workers to rake in $200,000 a year just to build these data centers. And so my kind of takeaway from this article, more than anything else, was that we're in the middle of a severe shift in our economy. 11% of jobs are replaceable today by AI, and AI is nowhere near what it's going to get to. And that doesn't necessarily mean the jobs are going to go away. That's possible, but I do think that a lot of jobs end up getting replaced, and demand for workers is going to move elsewhere. And for the time being, frankly, because infrastructure needs a complete revamp, construction workers are one bucket where we just need more workers, and so they're getting paid lucrative paychecks to come and do these jobs. I saw something that basically maritime shipping as well. You can make $200,000 to do these jobs as well, just because they're so understaffed on all these boats. And so there are plenty of different places where I think that these jobs are going to start appearing just because of macro trends and things like that. I just kind of wanted to put this out on the table and make this kind of an open conversation about what you guys think about maybe the workforce and how AI is going to shape the workforce, because it's less about the data centers here and a little bit more about how the workers are being offered lucrative payments to come and do these construction jobs.
Yeah. I mean, I think that this is something that you don't ever really hear about in the news. You're not thinking about the jobs that it's creating. You're just thinking about, these data centers are going to fuel AI, which is going to take away jobs. But in the short term, the article notes that the construction industry is actually short 440,000 workers at the moment.
Yes.
About 50% of all sort of disruptions in construction are caused by staffing shortages. So there really is kind of a need for a lot of workers at the moment, and they're getting paid some very lucrative salaries, as you were saying. You can make definitely into the six figures as a construction worker, which is a great thing. And I guess kind of draws the question, how long is this going to last for? How much longer are we going to be building out data centers? There's still 400 in development right now for the bigger tech giants at the moment, but not sure how long it's going to last. Maybe Adam can shine some light in there.
No, I absolutely cannot shine light there, but my thoughts on this are a few that I think. One, like, having more labor wages is obviously a good thing, and that these workers are in demand, and there are more data centers that people want to build than enough qualified workers who can build them. So I think that this is good for those workers, obviously, but I think that it puts even more questions around the thesis of, is this AI CapEx going to be worthwhile with these data centers becoming increasingly more expensive and labor costs being increasingly expensive. And then the other thing, kind of to James's point, is that I do see this sadly as like a short-term phenomenon, that you have some of this employment boom and the construction of the data center, all these people coming to the site, but when it's up and running, maybe it's just a few cooling technicians, and
Correct.
other than that, it kind of runs dormant. And I think elsewhere in the economy, I think that we've kind of seen GDP and like how labor is doing become less correlated. I don't know if you've seen this, but at least in real estate, and I'm trying to learn more and more about hotels, like going to next summer, and people in the hotel industry aren't doing as good, which you'd normally expect when GDP is doing well. And that's partially because of all this AI spend. So I kind of wonder, like, this seems like a good example of where AI is doing a good thing, and this AI infrastructure is helping people at the ground level. But I don't know that that is the best broad narrative for the economy. But that's just my take.
Yeah. It's like, adding on to your point, like, stock market's going extremely well, of course. GDP is growing, but jobs are not looking as hot. So that is kind of the issue that we have here, and this is kind of the dynamic that we keep talking about, how maybe GDP isn't going to be correlated with the job market anymore, and maybe rising unemployment is even a good sign. Maybe people are assuming that these AI bets are paying off. So that's kind of the broader idea here, I think, that we're kind of touching into.
And I mean, I think to me, something that's interesting is if we look at any new technology, it tends to get very overestimated in the short term and then underestimated in the long term. That's a very generic thing to say, but it's just very true. So I think that when we hear all this kind of noise in the short term about what data centers can be, about what AI could be, it's definitely true to a degree, but maybe not in the next 5 years, maybe in the next 20 years instead. And then in terms of the workforce, the one thing that I'd think, and maybe I'm kind of alone in thinking this, but I think because of the developments that we're seeing in AI, we've seen America over the past 100 years become something that's much more of a white-collar economy that works a lot more in the services space and things like that, and just desk jobs and things of that nature. I actually think we may see a transition beyond, I think, shorter work weeks, which have been a trend even over the past 100 years. I think we may also see a trend back towards blue-collar work in a large swath of America, just because I think to facilitate, again, the infrastructure to assist this AI, to develop the AI, to be the technicians and those sorts of things, these are blue-collar jobs. And if AI can start to replace jobs, it's going to be more in the white-collar space, would be my kind of perspective on it.
Right. And that's a big shift from what has been happening, because I think of automation in like auto factories and stuff, and that like a lot of those blue collar workers were the ones being laid off. But now with AI, we have the brain power, but we don't have the body. So I think that's going to be an interesting development too, just to see how labor markets react, how people's training react. Because obviously at Brown, they're really focused on the mind, not really focused on the hands and how to fix the toilets and whatnot.
Well, that's the thing. I don't think it's going to be a very welcome transition to a large extent, because I don't know how many people are going to want to give up their 9 to 5 behind a computer to then go work out in like in a construction site. It's just not something that I think a lot of people are going to be accustomed to as an experience that they want to do. But if AI can replace you working behind a desk
People like
crunching
those
numbers
email
in Excel,
jobs.
yeah, exactly,
Oh my
sending 5
gosh.
emails a day or whatever. I mean, AI can do that for you. So, but AI can't be your plumber. So I think that's just going to really change things.
Yeah, we'll see the trend unfold. I feel like we're almost already starting to see it unfold. People saying college isn't worth it, especially as the tuition continues to climb each year. I don't know. It's going to unfold.
Yeah.
Shorter work weeks might mean more video streaming to transition into
Wow.
into Paramount. I was
smooth transition. Yeah.
I tried to see. I was able to see this big pitch championed by Marco. It was excellent, and there's been a lot of new headlines around it, specifically around this pending Warner Brothers. There's a bidder between them, Comcast, and Netflix, all trying to get these Warner Brothers assets. A deal was announced with, I believe, the Champions League, which is amazing, because we know, I mean, soccer is a bigger sport than usually a lot of Americans can comprehend.
I'm a big soccer guy, so
there you go. Okay.
There we are.
But I think Marco should be able to give us better context here on Paramount's initiatives and what we should be looking for from this company.
Yeah, look, I mean, I'm not going to pretend to be an expert in Paramount, but I may be the resident expert. I maybe in the room of three. But so what I would say is, I think that this really boils down to Paramount wanting to do a lot of offensive M&A. And to me, why that's really exciting and interesting is because the media space is one that's very driven by consumers' tastes, and those change all the time. And especially with, again, if we talk about AI, like Sora AI, things of that nature that are generating videos, I think that the media space, alongside many other sectors, but especially the media space, is going to have a lot of kind of noise and a lot of disruption in the next few years. And the best way we know for these big players to mitigate disruption is to acquire the disruptors. And if you have somebody like the Ellison family who's willing to sanction not just maybe something like the Champions League getting those rights, which is something that's a bit more of an institution. The Champions League, something that people love watching. If anybody loves watching soccer, they probably like watching the Champions League. And so, but that's something that's been around for a long time. But I think anything else that emerges, anything that's growing, things of that nature, I think that Ellison's more likely to pay large sums to acquire those new streams, those new types of content and things of that nature. I think in terms of the Warner Brothers, what I would say very briefly there is beyond just the basic economies of scale that they could get off of a merger there, going back to your point about like synergies of selling to a strategic or something like that for these private equity firms. I think if you combine two companies like Warner Brothers and Paramount Skydance, you're going to get a ton of synergies, but you were showing me something earlier about the fact that they could also deleverage, things like that, become more healthy financially as a joint company. And beyond all of that, again, this is the last thing I'll say, and then I'll pass it off to you guys. I think the last thing I would say in favor of Paramount is post the Skydance merger, I think there's a lot of confusion around how this company's cost structure is going to look in the next year or two. I think post any merger, it's just very hard to kind of sift through what's a recurring expense, what's a non-recurring expense, and what's going to be the layoffs, things of that nature. And once that's all kind of settled out, I think we're going to see that Paramount Skydance is an extremely healthy company with probably best-in-class margins would be my guess. And the market is simply not pricing that in as of right now.
Oh, great rundown.
Yeah.
Thanks for educating us with that.
Go ahead.
I guess something that we talk about a lot on this podcast is like monopolies, and we talk about competition a lot. This seems like one of the industries where having one larger player would actually be beneficial because you don't have to own a bunch of different, you don't have to own Netflix and Hulu to watch the same TV show or all this crap. So, I mean, would you kind of agree with that? What kind of, to your knowledge of the industry as well as Adam, maybe, what are your thoughts on maybe, looser regulation and sort of the streaming industry and maybe who you see could come up top there?
I'll just say very briefly, the average American household has 3 to 4 subscriptions. And 3 to 4 subscriptions is not that high in the grand scheme of things, just because I can probably name 10 companies that offer streaming services. And so I think it would make sense to consolidate everything at a minimum. I don't know if it needs to be a monopoly, but maybe get it to 3 or 4 really, really big players, just so the average American household can afford to have access to all different types of content. I also frankly think that the American households probably want to have less than 3 or 4 services because everybody's annoyed by how many services they have. So I don't think a full-on monopoly is necessary, but I do think reducing the amount of players in the space would be beneficial to everybody. It's impossible that you get Paramount and Netflix and all these other companies to just become one thing, in my opinion. But again, if you could just narrow the pool of players, I don't think that's harmful. But go ahead.
I guess my question there is, and this is someone who doesn't know much about the streaming industry, but how tied is it to the creative engine? Because I think of, like, people want original content. They want good content that they like to watch, obviously. I think that if you have one big fat player, like, maybe the incentives to create new, creative, innovative stuff go away, and they'll either just acquire it or they'll know that they have the only subscription in town, so other people won't try and challenge them. Like, how does the creative ecosystem work now? And what do you think could be threatened by the consolidation there?
Well, that's why I think you still need a few, and it can't just be one, because if you have a few, then let's say one guy now, with the way that the AI video creation works, you could have a guy in his basement who's creating a movie with AI that's an animated movie. It's completely possible. And so if that were to happen, if you just had Paramount that was the only game in town, let's say, it's just very, very hard for that guy to get a platform. But if there's 3 or 4 companies, they may all try to basically buy that guy out, offer him whatever pay package necessary to get him to come over to Paramount, let's say. And then now Paramount absorbs that guy and he gets to maybe disseminate his content to everybody within the Paramount ecosystem. And to me, that's healthier than just saying, oh, it's only Paramount. Paramount doesn't need to play ball with him. But if Paramount doesn't play ball with him, and there's also Netflix, Netflix will. So somebody's going to entertain these disruptors. So again, if there's going to be disruptors, there need to be multiple people to kind of create a home for them, is the way I'd think about it.
Love it. A little bit more competition. And while you guys were talking about that, just Googled something because I saw a stat about this. Watching every NFL game in 2025 could cost over $800.
That's absurd. As a football fan, that's absurd.
That is insane.
That's absurd.
So I feel like this is a serious issue that we have going on now, and maybe they'll ask you for some advice out there. I don't know.
We'll see. I mean, look, I think this space is ripe for consolidation, and it's frankly necessary. And it's one of those cases where I think antitrust should just stand back, because this is one where, for the good of the consumer, we do need consolidation. Unlike maybe some other cases where you can make the case that consolidation isn't what's best for the consumer, I think here consolidation is definitely the right way to go.
And when I think about like this industry in particular and the strength of someone like Netflix, and also your backers at Paramount, Larry Ellison, et cetera, like how should we think about what the traditional balance sheet of a company like Paramount would look like? Because when I look at it, it doesn't look great for a company that is smaller and acquiring something like Warner Brothers for $60 billion or buying Champions League rights for over $10 billion. Like that, those are a lot of big sums to be throwing around on these assets. Is there a lot of clarity on how these things are going to be funded? Are there going to be co-investors on this stuff, or what does that look like?
To be honest, I'm not completely familiar. The way I'll take a stab and I'll say my kind of perspective on this is, instead of having the off-balance sheet potential liabilities and things like that, you have an off-balance sheet billionaire worth however hundreds of billions of dollars, and he can fund whatever you want. So the way I'd think about it is, instead of worrying about, the data center could bust, with this guy, it's much more, Ellison can fund whatever we want. And I think for a lot of these companies that are backed by someone with such substantial capital to deploy, you're almost not concerned what the balance sheet looks like, because an injection is just so straightforward.
And some political help too, if their relationship with
and
Trump
some political help for sure. I mean, I think that these companies are more than their balance sheet, maybe, is the way I'd say it. But again, obviously you want to be concerned that if you're overpaying significantly for a bunch of assets, it's not a great sign. But I wouldn't necessarily be too worried about it. That's a risk with any type of M&A. So, and a lot of M&A, we all know, doesn't pan out. So. But yeah, I think Paramount will be okay financially with Ellison backing them. Yeah.
I like it.
Great. We love it. And maybe to close it out, unless you have any other questions, it wouldn't be a VW Exchange episode if we didn't talk about bonds or things that are going on there. So kind of wanted to bring up this story, kind of Wall Street Journal article. Basically what they're saying is that we talk about the U.S. dollar being, of course, the world reserve currency, has a lot of benefits, and that's about all that stands between the U.S. and a debt market complete freak out. We're seeing a lot of struggles in the U.K. and France. U.K. recently pushing out some sweeping new tax hikes, something that the U.S. has really shied away from, as their debt markets have taken a hit, and France even worse. Has an even worse debt pile, rising borrowing costs. Their government can't sustain the same leadership for a longer period of time. And basically with this is sort of a cautionary article saying that the U.S. is just about in the same boat as these countries. The U.S. deficit today is more than 7% of its GDP, which is, I believe it's GDP. It's 7% of something, which is higher than the UK's 4% of something. But
I buy it.
Sounds like a problem.
it sounds like a problem. It is a problem, and basically using these two other countries as a bit of a case study. And I would love to hear your thoughts on kind of the debt crisis, Marco. We've talked about MMT on this podcast. We've talked about trying to push for budget surpluses. Where do you stand here?
Yeah, look, I'm not much of a debt expert, so I'm going to defer more to you guys on this. My 2 cents here as a hybrid poli-sci major is I think politicians generally want to do what's advantageous for them in the short term because they're not getting elected in 20 years, they're getting elected in 2. And so if you're getting elected in 2 years, you want to make sure that you're not raising taxes on your constituents and you want to make sure that you're not reducing the benefits that they receive. The unfortunate reality with that is that it's very, very hard to remove any deficit that you have created. So if the U.S. is running a deficit of, let's make it up, $100. It's just not at all a real number, but let's say they're running a deficit of $100. I wish it were $100. They're running a deficit of $100. It's very, very hard to make it 90 because that means that either you're taxing an extra $10 or you're reducing $10 of benefits. And so I think that just getting the deficits under control is going to be extremely difficult until, and I hate to say it, the short-term ramifications of the debt crisis are so substantial that you have no choice. Because you need to be able to pitch it to the American people that, hey, you're going to have to take on a little bit of pain in order to prevent this massive pain that's imminent within a year or within 2 years, not within 30 or 20. Because I think even though we see this threat coming along, it still feels kind of distant, even if maybe it's not. But again, defer to you guys. Yeah, go ahead.
No, I think that's really my view as well. That I think that we see this in these stories that are brought up of talking about the UK, that she's bringing in all these tax sites and all of a sudden is very unpopular. In France, they say that there's a similar issue and that Parliament's not able to solve, or not Parliament, their government's not able to solve any of these issues and work together on it because you have inequality, you have populism, you have all these political threats. And what populism is to me is really like the epitome of that short-term bias of what you said, of that you're working for the short term and ignoring whatever the long-term ramifications are. And I think in the U.S. where this manifests itself is, to me, I manifests itself in the Federal Reserve of trying to put in a dovish Federal Reserve at the cost of potentially long-term higher rates, at the cost of potential inflation, because you don't care about inflation. You care about short borrowing rates, and you're going to put in whatever Fed chair, Fed governors are needed to make that happen. And I think that is problematic because I think the independence of the Fed, not to like muddle topics because I know that's a separate issue, is also something that I think is endemic of these issues. That's all.
Yeah, no, I love it. And unfortunately, I kind of believe that we're closer than we really believe to a massive debt blow up. I think that Liberation Day was a real, really reflected that. We saw yields spike like crazy, and there were bond auctions recently after, and it was the amount of bidders did not look great, especially internationally. So I think you're starting to lose a little bit of trust in where the U.S. is going. A few threats that the article pointed out were supply. So the U.S. has record high debts during peace times. We're not at war. China, reserve safety, and push away of allies. So all of it kind of leading towards sort of where we're going right now. It seems like more of an independent country, less of a global nation. Adding on to the fire here, but hopeful that we don't get there and that some sort of healing comes in the near term. But right now I think we're closer than people realize.
And one of the views, just to like give you a briefing on some of the other things that we've talked about here, is that with Trump coming into office and pretty willing to devalue the dollar, and we think somewhat willing to be reckless with monetary policy and trying to put in governors who are willing to cut rates, that has had a negative impact on the dollar. And what this article is saying is that the dollar is like really important to having a stable debt situation and having investors who are willing to invest in U.S. assets and invest in the dollar, because if you're having inflation that's eating away at those fixed income coupons that you're getting off of government debt. And I think similarly, it also impacts when people are trying to transact in dollars. If they're not sure of the value of those dollars because you know that they have whatever unstable government and they're willing to have inflation, etc., then they might be less willing to transact in dollars and will be wanting to transact in yuan or euros or whatever. So maybe that is another long-term threat that just comes from not having great long-term thinking.
Yeah, I mean, all I would say is, again, this almost ties back to the beginning of the conversation or one of the earlier stories we were talking about with the Bitcoin in that situation. Again, not trying to keep like supporting Bitcoin and all that because, I do think it has its merits, but I'm not going to die on that hill necessarily. I think that in times where it's not just the dollar, but a lot of these companies are facing serious debt loads, I think that people are going to look to havens that almost operate outside the traditional financial markets, and crypto is one of those options. Crypto, gold, again, just those sorts of options.
Yeah. We're going to have to talk more about crypto on this pod.
Yeah, honestly, guys.
That's the message. But
I was in our class, we were just, they said total fraud, total scam. I fought the fight, but
look, I think so too. It's just I'm willing to hear.
No,
I'm willing to hear.
I'm a believer as well.
We'll see. We'll see.
But,
We'll see. Yeah.
I'm open to it.
Exactly.
But I think that is a full Meetup Exchange episode.
Yeah.
Talked about things in the debt markets, talked about things in equity markets, and a fantastic streaming company. And I think that is all that we have for today. But we want to give a big thank you to Marco for coming on.
Appreciate you guys for having me. It was a lot of fun. I'd love to come back at some point. So,
we'd love to have you
It's
back.
a great time.
And our first guest ever. So also very, very grateful for that as well.
I'm honored. Yeah, I really appreciate it, guys.
Changing the game. Yeah, we appreciate you.
Thank you, guys.
But that's all. So thank you all for listening and take care.
Take care.